All right, good morning, everybody. So we've got a pretty deep lesson we're going to get into this morning. It's going to be specifically surrounding the topic of bias, right? Just like the whole process that's utilized to determine, what the daily bias and weekly bias or monthly bias could be. It could get a little deep. We're going to go over a lot of the main topics. I've talked about a couple of them, like seasonality and COT, a few times. But for the most part, we're going to try to cover a couple of different factors, and maybe touch on some things that you guys probably never dug into, really, or some things that you probably didn't even know were important. You know what I mean? So we're going to try to keep it as simple as possible. Things don't got to be rocket science. But yeah, with that being said, the first thing we want to, really sink our teeth into is risk on and risk off behaviors. All right. For those of you that don't know, risk on and risk off has to do with the relationship that all markets have with each other. Okay? Everything's connected. So when one thing does something, there's a correlated asset that does the opposite. Or if one thing does something, there's an asset or an asset class that is correlated with that particular asset. Like DXY and EURUSD, for example. Those are reverse correlated. But EURUSD and GBP/USD, they're positively correlated. Okay, so EURUSD and GBP/USD do the opposite of what DXY does. So if we're looking for EURUSD and GBP/USD to go higher, we would like to see the DXY go lower in terms of risk on and risk off behavior. Right? But when it comes to the indices, for example, the indices basically, you want to take the DXY and you want to take the interest rate markets and then study also what the commodities and foreign currencies are doing as well. Because when you make a decision as far as what you think the indices are going to do, on the back end, you want to have solid background information supporting the idea that you're trying to engage in. So risk on, generally the relationship is bearish DXY. Risk on also means, the market makers are willing to put risk on assets opposed to the DXY. Risk off is they're taking the risk off of assets opposed to the DXY. So risk on, you see DXY being bearish, bond yields, which impact the DXY, being bearish. But you also want to see commodities being bullish in that sense, like gold and stuff like that. Stocks being bullish, aka indices. And then currencies like GBP/USD, EURUSD, you'd also want to see those to be bullish. That is the risk on relationship. All right. Then risk off is the opposite, right? DXY is bullish, right? Preferably you want to see that taking place. You want to see bond yields being bullish. And then you want to see the commodities bearish, stocks bearish, aka indexes, and foreign currencies like EURUSD and GBP/USD being bearish as well. One thing I didn't note here, right? For risk on, if we want the bond yields to be dropping, we would like the T bonds or T notes, right? We'd like to see those doing the opposite, right? If the yields are bearish, we want the T bonds, right, or T notes to be bullish, which supports the commodity stocks and foreign currencies going higher as well. Okay? So I don't know why I didn't add that in this little list here, but you could see it over here as well. Right? So that's one step, right? That's one piece to the puzzle, right? So, that's like the first part. And if markets are symmetrical, as you're doing this analysis for risk on and risk off, just analyzing the markets as a whole, That's the first step to gauging whether we are in a solid, fast-paced, trending environment or if we're consolidating, right? Uh, it's very important to keep this in mind. Most people think, okay, let me just focus on one asset and I'm only going to look at that one asset. Well, you're kind of trading blind in that case because you're missing a critical element. That element is how connected the markets are as a whole, you know? And building trust is obviously going to come from you layering things like this on top of a opinion you're trying to place in the marketplace. All right? So I hope that makes sense, right? So write these relationships down. So next time you think you're bullish, if you're an indices trader, or even if you're a currencies trader or a commodities trader, this is going to be very impactful. It's not rocket science what I just mentioned here. Hopefully it doesn't sound too complicated, right? But that's the first step, right? Then of course, moving away from that, do I have seasonality in here? Moving on from that, then we look at seasonality. Let me make this bigger. So now we're getting into fundamentals here. First off, okay. So this is like back end information, that you're trying to utilize and layer on top of one another to try to eventually get to the asset of your choosing. You know what I mean? We do this first, generally every Sunday, for every asset we look at, but we're kind of generalizing the whole process just for those that have a hard time following along, and just maybe you guys wanted to see the process just as the process versus actively trying to identify something on a day-to-day basis. It's going to be a good reference for you guys to just make a checklist for. All right. So when it comes to seasonality, right, you want to look at each month, okay, and you want to observe the behavior you see within these three lines, right? There's a 5-year, 15-year, and 24-year, right? I'm only going to show this one, right, just to give the breakdown of analyzing seasonality itself, and then we'll speed past it. I have a lot of the resources in the free Discord, so if you haven't joined that, definitely consider doing that. If you want deeper mentorship, right, more intimate like relationship and more access, then obviously you can go through the paid route, go to my private community. So when you're looking at seasonality, you want to watch all three of these lines, identify times of the year, or identify each characteristic you see between that 3-line relationship for each entire month, right? So what was the behavior you can roughly estimate from the the view that we see here on this chart. You want to identify lows that lead to strong moves based on this chart here, and you want to identify areas where all three of the lines agree. If you see a time where all three of the lines are going sideways, generally things could be a little bit more hectic around those times of the year. So why is that helpful? Well, for one, it's going to help you manage your risk properly, because you'll know seasonally from the last 20 plus years, price has done this or done that, right? So if it's going sideways with all three assets, or all three time intervals, that being the 5, 15, and 24 year, then that time of year may present us with a little bit more difficult conditions to have to deal with. And you'll be fascinated, as ICT has said before, at how accurate this data is. If you look at the higher time frame and you take this analysis you do, right, assume whatever you see in the chart, right, is a bullish, bearish, or consolidating, right, slow market. You note that, and then you go into your chart and then you observe on that higher time frame, and you see, right, what has price done the last 10 years, the last 5 years, the last 15 years, just the last year, right? Pretty much right away, once you identify, go through this little process and identify significant lows, times in the year where all three lines agreed with one another, and then also times where, price got stuck, right, at certain times of the year. You quickly see, just by doing that little breakdown, that little analysis drill, how accurate this is, how consistent and repetitively controlled things truly are. ICT calls seasonality a roadmap, right? Because the market follows this in dramatic fashion for the most part. So in a nutshell, that is seasonality and how you use it and how you go and study it. You take resources like this, which I provide, and you do that, and you do that analysis on the lows that you see that lead to big moves, highs that you see that lead to big moves, and times in the market, throughout the year where everything is agreeing based on all three time intervals, and then times where things look like they're stuck, right, going sideways. Right? This is all very impactful, and you want to keep a rolling log of this, okay? So I hope that makes sense. If you guys have any questions along the way, let me know in the chat. Otherwise, we will speed through some of these pieces of information. All right. And then the next is COT. The next is COT. Okay, commitment of traders. For those of you that don't know what that is, commitment of traders has to do with large funds and large funds and pretty much their positions that they document at the end of every week. Basically, it tracks smart money. It's a very laggy indicator, okay? And, something may be showing up in the COT. Maybe it shows a bullish signature, right? Or a bearish signature, which we'll kind of break down right now, how you can identify that. But sometimes it'll take a long time. The large funds can stay in positions longer than we can hold positions, and, longer than is reasonable for us normal people to hold positions, right? They can hold it for months, weeks. So it's very important to take COT and obviously use these other pieces of analysis, but look at the actual chart and see if it's confirming whatever signature, whatever signature you are assuming could be in the marketplace, right? Or in the COT data. It has to align with current market conditions. Okay? So let me pull that up real quick. This is our private community, right? For those that don't know, these are a lot of the topics and pieces of information and many resources you can get access to. A lot of this stuff is offered for free, but obviously there's deeper levels we can go with every topic, so definitely consider that. If I could find it. So yeah, commitment of traders, right? Let me actually pull up the current one. Okay, so this is what we see currently in the COT data, right? COT data is taken from barchart.com. I have talked about this a couple times on the channel and in live calls on this YouTube channel. Definitely in great detail over and over again with private lessons as well in my private community. But for the most part, this upper line is called open interest. Okay, it's basically tracking the open positions smart money is engaged in. And when you see a large drop in open interest with a rise in COT that looks so dramatic like this, this could be signifying the fact that smart money is looking to offload their short positions. Okay? So if we go to, let me see where the thing's at. So if we come over here and we look at this signature, right, we see a drop in open interest, dramatic drop, and a dramatic rise in COT. That is a bullish signature, okay, meaning they're offloading their short positions. Does that mean it's going to happen tomorrow? Absolutely not. Does this mean because we see this bullish signature in the COT chart that we go in and start buying when price is declining? Absolutely not. This just helps us identify and build a layered confirmation that the buy position, if it shows in the asset we're trading, right? If it shows buys are active, maybe there's a break in market structure, maybe there's 3 PD arrays that get violated to the upside, and there's a clear draw in liquidity above price, maybe equal highs, maybe it's a PD array of some kind, fair value gap, maybe it's, something along those lines. If this ends up aligning with the current price action in the asset that you're trading, it's just another layered confirmation, right, to help you build further trust, right? And then, of course, the opposing view is true as well. If you see the open interest rising aggressively, but we see the COT line declining aggressively, right, just pretty much the opposite of what we just looked at over here, right? So decline, rapid increase, right? That is a indication that they're offloading their short positions. But if it's vice versa, right, the other way, like say this, for example, price going, or the open interest going higher dramatically with the COT going lower, right, that means they are offloading their buy positions. As you can see, that aligns with this drop here that ended up declining. What did they do? They were offloading their buy positions. And again, this is the signature for them potentially in the process of offloading their short positions. So, I mean, you can kind of dramatically see instantly, based off what I just mentioned, between the relationship between open interest and COT. And then you take that to the chart and you see the impact that happened later on. This is offloading buy positions. This is a signature signifying offloading potential short positions. Again, this is a lagging indicator. It's not something you go into and start demanding, especially when there's chaotic stuff happening in the world that we can't really gauge what the response is going to be, like changing economic policies and whatnot. But if price ends up, maybe breaking this high, and we see this continuing to be the case here, then we can know that we can trust a more long-term buy position, right? So in a nutshell, that's pretty much the gist of, at least a basic view of how to use COT and how to analyze the relationship between these two lines, right? Obviously, there's great detail that we can go into with this, but this, in my opinion, is enough for you to get into the COT and start to analyze it, right? And get a feel for how it impacts things, how it's a laggy indicator, the two signatures to observe, and how you can go forward and end up trusting the COT analysis that you operate within, right? Even if you do it at a basic level. It's not a be-all, end-all. It's just another layer, right? So we went through risk on, risk off, market sentiment as a whole, seasonality, and COT now, right? So the last fundamental analysis process I like to utilize is based on the interest rate markets. Those of you that have been with me for a long time, or even a short time, but have been on all my live calls recently and just over the last couple of years, or even the last 6 months, the first thing we start off with, aside from the news for the week, has to do with the interest rate markets, right? They're very impactful, right? The bonds, T-bond futures, T-notes, right? They're classified in two different ways, but they mean the same thing, T-bonds or T-notes. This impacts what the foreign currencies are going to do, right? And what the indices are going to do. It has a heavy influence, like a heavy hand influence behind the price delivery we see. In the foreign currencies, GBP, USD, Euro USD, and the indices, okay? And then we also have the yield market, right, which does the opposite, and it impacts directly in a positive way what the DXY is going to do, okay? So obviously if the yields are going higher and the bonds are going lower, if you're an indices trader, we prefer to see the indices favor the downside, right? Because that's generally how things go. And then if we do the opposite, right, we see the bonds going higher and the yields going lower, we would expect lower DXY, or try to make an argument for lower DXY, and then higher indices and foreign currencies and commodities and things like that. Okay? So in a nutshell, that is the relationship that we like to observe. That's why we do analysis on these things first. The things that I just mentioned to you are the first things that I look at and reference. Seasonality and COT I do every month, so that's for the monthly analysis. In the start of every month, so I glance here and there every other week, because those things don't change dramatically. They don't change on a day-to-day basis. But they do have a heavy impact overall, more long-term. That being like a week, 2 weeks to a month, sometimes a full quarter. Especially if we go into a new quarter like we did like a week ago, or 2 weeks ago. We went from the first quarter to the second quarter of the year. Okay? And generally you want to make sure you're glancing at these things and observing higher time frame SMT when you're doing quarterly analysis as well. Okay? So bonds and indices move together. Yeah, so for the most part, bonds, the bond market, right? T-bonds or T-notes, this market here, generally has a positive impact on what the Euro USD, GBP USD, and the indices are going to do. And the yields market, right, the bond yields, that being this market here, generally dictates and has a heavy-handed influence on what the DXY is going to do. Because currencies chase yield, per ICT's explanation. So currencies chase yield, right? So if currencies chase yield, and we're looking at the DXY, and this is the bond yield market for the DXY, every country has a yield market for their currency. And they also have a bond market for their currency. Okay? If currencies specifically chase yields and we're observing the DXY, then the currency, DXY, should chase whatever the yield market's doing, that being this yield market. Does that make sense? I hope that makes sense. Right? Again, we don't have to know what bonds are and the whole scientific back-end financial instrument use cases and all that, what it does for countries and whatnot. We don't got to know that. We have to know what the relationship is if we're looking to utilize it in trading. At least that's how I view it. Because I'm a simple person. I'm not a rocket scientist or a computer coder, right? So I just want to know how it's going to impact my analysis and how I can use the tool to improve my assumptions in the marketplace and make educated decisions. And I'm assuming majority of those that aren't computer scientists and computer coders and complex individuals think that way as well. Like, you just want to know how does this help me and why? Why is it important and how do I use it? In the most simple, effective manner possible. What I just explained in the relationship between these, from COT to seasonality, risk on, risk off, and then of course all the way to what we're looking at here, which is the interest rate markets. I like to keep it very simple, focus on how it helps me and why it's important. And that's it. I don't care what it does. What does the interest rate market dictate? I don't care, right? In terms of, the real world use cases. I really don't care. I know a little bit about what it does now, obviously, because it's been years. But yeah, we just have to know why is it important and how to use it. And I hope that I've been able to get that point across here. Now, one thing I want to mention before I move on from the interest rate markets, part of the use case, if there's a cracking correlation between the bonds and yields and the assets that they impact, right? Say, like, for example, the indices have been falling, right? But the bonds have been somewhat consolidated and, looking like they may want to continue going higher, So there's a cracking correlation. And if we look at the world right now and try to figure out why that is, why that's occurring, what could be impacting that, what's a direct correlation with what's happening with the U.S. economic policy? So things have been very sporadic and fundamental analysis has been a little hard to get a hold of and see it manifesting in the chart. A lot of times, this could take place when things are happening in the country's specific economic policies, right? There's a bunch of chaos in the world. Sometimes, even things outside of your country. Since we're trading the indices, wars, dramatic adjustments in economic policy, like I mentioned, those types of things can lead to lack of symmetry in the marketplace because the market's trying to figure out what the hell it wants to do. There's a lot of uncertainty, and things are just sporadic and chaotic right now. A lot of people will see the relationship not work a couple times or for a length of time, maybe a week or a month or sometimes a little bit longer, and they'll think that now there's no use for the topic. That's okay if you want to think that way, but when things do kick back in line, right, you want to make sure that you have the skill set. If not, so be it. I just like to do things that help me and my students build the trust, because that's the hardest thing to do in in the marketplace, is build trust and why your idea should come to fruition. And part of that has to do with what we've just discussed here. Those 4 elements: the risk on behaviors, how everything's connected, and what the relationships are between each asset. Seasonality, what the market seasonally does based on the asset you're trading. COT, to try to get a feel for offloading of buy positions or offloading of shorts, right? Where's the interest at in the marketplace based on that data and the relationship between the COT and open interest. And then, of course, the interest rate markets and how that impacts the specific assets we're trading, because currencies chase yield. And if we're trading the indices and DXY has an impact as far as what the indices are doing, then I want to know what's influencing the indices. And then as a result, what will also have an impact on the indices, because that's what I mainly focus on. And you could do the same process for all the assets you trade. If you're in a different country and you trade a different asset class, again, these dynamics are very similar in every country. So the process is very similar. But of course, this is the U.S. Market, right? So I stick to specifically what I deal with. And you could trade commodities, you could trade Forex, and all these same things apply. All these same principles apply. It's not just an indices thing, it's a whole of market type thing. All right? And it's the how and why, right? So again, the reason we start there and go through these things and why these things are important is because they impact what it is that we're going to see in the indices. And specifically, we trade the indices, like I said. So I personally, from my own approach and what I teach the students that come to me to learn, I teach them about these back-end pieces of information, and over time, there are things that you'll look at, and because they take a little bit of time, it just adds on to the reason why trading takes so long to master and to really become a professional, because some stuff is time sensitive and it takes time for things to unfold. And if you're not actively identifying things, if you're not actively keeping some of this stuff in mind and seeing how it translates to the market over time, you never learn how this stuff can be helpful to you. But again, that's why this takes so long. Aside from the technicals, where's an entry, what's bias, so on and so forth. That's why it takes so much time, because it's more involving than just looking at one asset and just assuming that asset and higher highs, higher lows, right? There's more to it than that. If you want to be a consistent professional and you want to be able to sit in the chart, maybe you want to become full-time, If you're going to be full-time, or if that's a goal, obviously you want to have as much weaponry as you possibly can to justify whatever decision you're making in the marketplace. So you can have a feeling of comfort, of reliability, of more than just assumptions and randomness, And this process, the way that we operate within the marketplace, the way ICT operates himself, affords us that ability to have that trust, to build clarity and build the reasoning behind why the market should do one thing or another, or why it shouldn't do one thing or another. Okay. So yeah, as far as the fundamental frameworks and just process, that is it at a decent level, right? Obviously, we could take each of these topics much deeper, but again, keeping it as simple as possible, as applicable as possible, minimizing as much confusion as possible, but keeping the effectiveness and important pieces to the tactics I've talked about here. I think this is enough for these four aspects: risk on, risk off, seasonality, COT, and the importance of the interest rates and how all that impacts the indices, commodities, and foreign currencies, depending on what kind of trader you are. All right, so then another layer, right, we'll talk about fractal patterns. Okay, so this is starting to lean into bias, right, on a day-to-day basis. Aside from some of the things that we just mentioned, right, this is a wonderful addition, right, because most people don't understand this. They don't really even see. They see like this indicator that, oh, okay, it's a fractal pattern. Okay, what's so great about that pattern? Well, this 3-bar pattern, and that's important to justify, right? It's a 3-bar pattern. If you have some indicators, they say 5 bars. ICT has mentioned before that if you identify a fractal pattern by 5 bars, you've already missed the point. You've already missed the move. It's already taken off. You're late to the party. So that's why the 3-bar pattern is so important. Fractals can also be impactful in the lower time frame, but we're not going to get into the lower time frame discussion. You want to identify fractal highs and lows on the lower time frame because it helps you identify actual structure that you can place your fib on that can be accurate. And again, maybe I'll make a whole entire video about that aspect of things. But for the most part, because this is a video for the keys of daily bias and weekly bias, we're going to stick to what I'm going to talk about here. Okay, so when price rapidly reaches to a particular level, right? If price runs aggressively, or if price is in a mode of retracement, when you see a fractal pattern form, okay, like let's use this for example up here for a fractal high. Right? If we're bullish, okay, that's great. Once we see a fractal high form, the next day or two after that third candle forms, it's reasonable to anticipate that there's most likely going to be a retracement, considering, in this example, it was bullish. Once that fractal pattern formed here, the next 1 and 2 candles can be reasonably anticipated to go in that intended direction. Sometimes, obviously, it's not perfect. But for the most part, if you go back and backtest, generally, this idea unfolds. Okay, so when you see a fractal high, if we're going higher, the next 2 candles after that third candle forms that creates the fractal high, the next 2 days can be anticipated as potential retracement days. Right, so this in this case, right, it retraced to what? To a fair value gap and an order block. Right, so very, very simple way to view things. If you see price moving one-sided and it hits a level like a PD array or it takes out a buy-side liquidity pool, if you see a fractal form, your eyes should go down into the range, because that could trigger a retracement. So what is a fractal high? So I pretty much just explained that, right? A fractal high or fractal low, right? Fractal high is a pattern, a 3-bar pattern, which you see here. This indicator I have showing these arrows, it's highlighting each fractal pattern, right? Each fractal high, each fractal low, based on ICT's teaching of the fractal pattern. See, there's the fractal nature and price, and there's a fractal pattern. Those are 2 different things, right? So a fractal high is a high that forms with a higher high in the middle, a lower high to the left, lower high to the right. Right? Simple as that, right? So that creates a fractal high. This right here is not a fractal high just because it's a high. This down here is not a fractal high. This high of this candle is higher than this one, right? So it didn't present the arrow. There's not three. Yeah, it's basically a swing high or swing low, but it's the actual way to observe a valid swing high and swing low. Okay, if it's not a fractal high and low, it's most likely not valid for being a significant high or low. When you're identifying intermediate term highs and lows, long term highs and lows, and short term highs and lows, this is very, very important, because if you can't identify an actual valid swing high and swing low based on a fractal, right, the understanding of fractal patterns, you're not going to be able to anticipate the actual lows and actual highs that are important. Okay? So yeah, again, when it comes to bias and the importance of the fractal high and fractal low, right, if price is one-sided, for this example going higher, when a fractal high forms, after the third candle, your eye should go directly into the range that's being created that, could reasonably be retraced to, because the fractal presents us with a timing tool identifying when a retracement could take place. A lot of times this will form at a PD array. Maybe this is a bearish order block, or maybe it takes a high, right? Because that's also a PD array as well. Okay. So yeah, when a fractal high forms, it could be indicating that there's, for the next 2 days after that third candle forms, creating the fractal, the next couple days could end up being a retracement. So when you see that form at a high, you want to identify something that's below price. For example, these lows here and the fair value gap. This is something that real time we observed. Okay. This is something that's constantly in the chart that I'm identifying, but didn't really talk about a lot. Okay. So it's something that many people overlook as well, because it seems very simple. It seems very basic, but the way that it's used in terms of ICT concepts is not traditional at all. Okay. So yeah, that is pretty much the gist of like a fractal high. And then same thing's true with the fractal low. Even if we're continuing to run higher, if you see price presenting a fractal high, it retraces, and then all of a sudden, keeping in mind that we're in a bullish trend, then all of a sudden you see a fractal low form. A lot of times it's going to happen at a PD array, like I mentioned, with the high, right? Maybe there's a bearish order block or something, or a fair value gap. Same thing's true here if it's looking to go higher and you see price retraced. If a fractal low forms inside of a PD array and we're in a bullish trend, once the third candle is formed that presents you with that fractal low, and you have a reasonable understanding that's going to go higher, that candle that forms after the fractal is presented can generally be anticipated, at least for 1 or 2 days, to continue going higher. Okay? So I hope it makes sense as far as the importance and pretty much why I'm talking about this in terms of the keys to daily bias and weekly bias. This is a weekly chart. Same thing happens on the daily chart. But I hope I'm getting the point across, right? For those of you that are here, let me know in the chat if this made sense. Because if it's feeling disjointed a bit, I'd be happy to answer questions. Okay, Sufi, so it makes sense? Oh, by the way, if you guys get value from the video, don't forget to like the video. I forget all the time to like people's videos when I'm watching, but just a reminder, it helps the channel out, and it's much appreciated. Tells people that they should get on and watch these videos. But yeah, let me know in the chat, Sufi, if that made sense. Okay, you learned something new, so I'm assuming it made sense. Everybody else, let me know in the chat. Nutty Fafa and anybody else who is on with me right now, let me know if that makes sense. The importance of fractal highs and lows on the higher time frame when they're identified, and what they can be utilized with in terms of the daily bias and how they help us. Yes, that makes sense. Okay, beautiful. It's a very down and dirty, simple, simplistic way of viewing bias, and just one of the extra weaponry we have in the toolkit. All right, so yeah, let me know. Okay, yes, okay. All right, perfect. Right, so again, this is a fractal pattern, right? The fractal pattern is fractal, right? Basically meaning it's the same thing can be applied to every time frame. Obviously, when it comes to daily bias, you want to make, or weekly bias or daily bias or even monthly bias, you want to make sure that you're paying attention to the higher time frame, and finding these on the higher time frame can lead to larger directional moves, even if it's just a retracement. So identifying a fractal can also assist you in understanding how to identify retracements. All right, I've talked about how to identify retracements using opposing PD arrays. Well, now you have another layer to that. An opposing PD array, if price trades up into, say, like a bearish order block for this example, and it makes a fractal high at that bearish order block, you can be pretty certain that it's going to give a strong retracement down to, in this case, a discount array, because it was bullish, right? Of course, it ended up turning around, right? Broke this low. That ended up being a break in market structure. Broke 3 PD arrays, and as a result, price ended up declining aggressively, which we were ahead of real time. Fractals can be retracement or reversals. Yeah, fractals, a better way to look at it is fractals can trigger retracements to opposing PD arrays. If you see them form, like in this case, a fractal high, it hit a higher time frame PD array, so that triggered in a retracement to a discount array in the bullish trend. And then obviously vice versa for buy positions. But then if a fractal forms inside of a discount array and we're going higher, it can also lead to continuation. So reversals can be identified, and continuations can also be identified, or it can assist you in those when you see a fractal high or a fractal low form, depending on obviously what's happening in the chart. All right? So yeah, I hope that makes sense. It's very, very powerful. Most people will discount the idea we just talked about here until you go in the chart and actually apply it and see just how amazing it is. Even if you backtest and just look at previous data and identify when fractal highs and lows form, depending on what direction price was going in, and consider some of the things I just mentioned, and you'll see it's fascinating. It's one of those simplistic things that is extremely dynamic. And ICT's talked about it in some of his older YouTube videos. He gave it away for free. We pretty much gave everything away at this point. But, a lot of stuff's overlooked, and there's so much information, people don't know how to piece it together. But that's why I'm here, okay? To try to help cement things that get overlooked. All right? So, yeah, I hope that made sense, right? And if that made sense, we will move on. So the next thing has to do with, layering confirmations. Essentially, it's just keeping in mind higher time frame levels, PD arrays, higher time frame liquidity levels, and transposing those down into the lower time frames. Okay, continuously layering those with confirmations we also see from that lower time frame. So basically bouncing from higher time frame PD arrays, dragging those down to the lower time frames, and not forgetting that they're important. Don't get stuck on the lower time frames forever. You don't want to deal with the lower time frame situation when you're trying to figure out how to catch your footing and how to be consistent. Because the biggest moves, large ranges, will come from higher time frame PD arrays. And you can do your own back testing on that, and you'll see quickly that if you want to be a part of the large moves, yes, we want to find lower time frame elements to our model, of course, right? Because how are we going to enter? We want to be able to observe that. But in order for you to catch larger moves than the minimums, which I preach, right, 20, 30 points in the NASDAQ, 5 to 10 points in the indices, ICT mentions that too. But if you want to graduate from that, your graduation to larger moves is going to come from framework on the higher time frame PD arrays, for example, and then transposing that to the macro you trade within the kill zone you trade, right? Within the session you trade, and then taking your entries on those lower time frames to shrink risk and make your entries a little tighter. Okay, but everything is derived off that higher time frame. Again, we're in a conversation about bias, and everything bias related, if you want to have reliable bias and something you can trust that results in, nice moves like last week, right? Sufi saw, I called it a week in advance. Everything played out exactly how we wanted it to play out. That's directly a result of the things we're talking about here. and framing things on higher time frame charts. Okay, why did you use the fractal low as market structure shift and not a series of up close candles as changing the state of delivery? Where exactly do you see that taking place? I'm not sure exactly what you're referring to here. Haven't really marked anything. Why did you use that fractal low? You talking about this fractal low here? So this here ended up being a break in market structure, because you couple that with the failure swing up here, which had SMT, and then also the multiple PD arrays that was violated to the downside. You couple that with the fact that this low was violated, turn this into a break in market structure rather than just a shift in market structure, because this is an example of a break in market structure, right? A shift in market structure, right? You could see a swing low like this, but it pierces it slightly, but then goes right back above quickly. But we have multiple layered confirmation with SMT, the drop below this, and 3 PD arrays that were violated, resulting in this being a trustworthy break in market structure, which ended up breaking down. Also, the order block here, I talked about this real time as well, saying that if the midpoint of this does not get violated, we're most likely going to see this continue to support down delivery. And obviously, it couldn't even get up into that. We also see the wick here, right? Price couldn't even get into the midpoint of this wick. It stayed also below this fair value gap, which presented us with evidence it was an inversion. So that was, a little bit of the context that kept us favoring DXY taking a nosedive to the sell side down here. And then, of course, it delivered much more. This fair value gap, you drag that over, you see how it's overlapped with this. That creates a balanced price range. So, if DXY continues to stay below that and doesn't get back through it, we will continue to see price decline. Obviously, it's a lot of pretty advanced stuff I just mentioned there. But I can make a whole video about breaks in market structure versus shifts in market structure and balanced price ranges. We could get into very deep details about that, which we will. But definitely later on, right? But yeah, so I hope everything we've talked about so far makes sense in terms of the layering confirmations as well, the importance of dragging higher time frame levels down to the lower time frames, staying rooted on that higher time frame when you're navigating the lower time frame, because it's so vitally important. The lower time frame means nothing if you don't understand what's happening on that higher time frame. Obviously, there's people that make the argument that they don't use higher time frames and whatnot, but that's not me. That's not the way I trade. That's not the way that my students have been able to do well. They've been able to do well and achieve what they're achieving at the moment because of the things that we're talking about here, and some of the private calls and working through some of their own issues, right? Specifically using the things that we talk about, So yeah. So we've talked about risk on, risk off, seasonality, COT, interest rate markets, the fractal pattern, the importance of that, how to use it in bias, in the context of bias on the weekly, daily, and monthly chart, how it's fractal, right? You can use a very similar tactic on the lower time frame, but when it comes to bias and narrative, it's very important to identify when these are forming on those time frames, because higher time frame determines narrative. Okay, and then if you can nail that down and get a fractal high forming on the daily chart after price has been going higher, or the weekly chart, you can rest assured that the next couple days, once the fractal forms, will most likely retrace. So you can frame out counter trend ideas, coupling this tactic with the opposing PD array idea I've been mentioning. How opposing PD arrays, if we hit them, a lot of times that'll trigger in a retracement, tradable retracement. So those are two pieces to counter trend frameworks of you feel comfortable using that tactic. But then it can also present you with evidence that it's time for price to continue, like to start back into the continuation. If a higher time frame PD array is met like this, right, in a fractal low forms, if it's going to continue and keep your narrative going, right, it's going to continue to go based off the starting point being a fractal low. Because it failed, right, that's part of a signature that tells us that it's not going to work properly, right, that it's potentially not going to respect, in this case, the uptrend. Okay, so again, it's part of our invalidation validation principles as well. So you can see how important identifying the proper fractal highs and lows are. Okay, and then of course, like I mentioned a minute ago, we talked about layering confirmations from higher time frame, dragging those down to lower time frames. Vitally important topic, because if you don't know what's happening with those higher time frame levels, and you're on the lower time frame trading, trying to figure out what to do, where it's going to go, you're trading blind. Similar to how, if you don't incorporate some of the other things we talked about, you're missing a huge chunk of the storyline that can really, really amplify your consistency. All right, so far I hope these 6 topics have made sense so far. And now we're going to talk about Power 3, okay, and how that also has an impact as far as narrative and daily bias is concerned. Okay, so if you're assuming that the higher time frame is telling us that price is going to go lower, okay, given the fact that Power 3 is always in the chart, right? If we go to the daily chart, each of these candles has a Power 3. Okay, there's a open, high, low, and close for every candle. So if we're looking for price to decline, and we're trading like today, for example, we want to anticipate the opportunity for price to go higher in some capacity and then go lower as we move into the session we're trying to trade in. London generally can create the consolidation and manipulation, sometimes can start the move and present the high or low of the day. And then, of course, New York AM and PM session, if you're trading the indices, can end up presenting you with a continuation or a entire reversal, depending on the circumstances. So coming off of London, if you go into the AM session and you see that overnight price ended up leaving a high and started to decline, you can start to see how, if you incorporate all these other things I just talked about, and then you can also observe and understand the Power 3 dynamics. And if you can see, like for example, a bearish Power 3 taking place within the context of a bearish delivery, which we confirmed using the other tactics I just mentioned, you can see how Power 3 can end up being another layer to building trust behind a bias or narrative. And you can use it on the daily chart for the daily ranges, but then you also have the same tactics, same perspective when you're looking at the weekly candle and the weekly delivery and weekly Power 3 perspective. Okay, so it's all the same thing. If we want the next weekly candle to be bearish, we want to start the week going higher in some capacity. Going higher for what? Going higher to hit a PD array that could set up a short position if lower prices for the week is what we're anticipating. Okay, same thing for when we're looking to go to the buy side, right? If we open up for the week, we want to see the start of the week drop in some capacity to a liquidity pool of some kind, a PD array of some kind below price, a bullish PD array. And then once it fulfills that, right, we can incorporate all the things that we just talked about, fractals, interest rate market, COT, seasonality, risk on, risk off, and come to a very solid understanding as far as why price should go higher or why price should go lower, right? And then, of course, keep in the context of Power 3, like I mentioned. So you can see the layering effect that's starting to take shape with the things that we've talked about and how I come to a determination as far as, me thinking price is going to go higher or lower, right? Having all these boxes checked, you can imagine the confidence once you get good at applying the process here. We're not done, by the way. But you can start to see how confidence can slowly creep into what it is you're trying to do. And it can build trust and confidence and allow you to hold price longer. And if you're incorporating the layering effect from higher time frame to lower time frame, You can make very strong assumptions that, you're in line with a good move, a fast-paced move. And of course, we could dig very deep into Power 3. I have a series about that. So if you're kind of sloppy with that or ill-informed with that, you can dig into some of those lessons I have in relation to Power 3. But then, of course, you can also join my private Discord. Or, if you can't do that, maybe you don't have the means to do that, or, for some reason you just can't, you could join the free community, right? I also have a lot of breakdowns for basic stuff and direction-based things for the new student, or even the seasoned student that just wants to sharpen the edges. Maybe there's some weaknesses. But regardless of what kind of trader you are, you have a home here in the WMG family, right? As many of you guys have known, right? Or have witnessed so far. Sufi, your brain's melting knowing how all these things come together. Yeah. Mind you, I hope that the things we've talked about haven't seemed like rocket science. A lot of this stuff is very to the point. I could make things as complicated as I choose to, if I chose to, but that doesn't help anybody, and I'm here to help, I'm not here to get rich selling a course, okay, like majority of these people are. Even if I did sell a course, it'd be proven in terms of the efficacy and that things work, opposed to the way all these other people do. They don't even go live. They can't call the market, yet you're supposed to believe them because they have a Lambo. It's ridiculous. But yeah, so I hope that makes sense as far as how Power 3, along with all the other things, can be layered on top of one another to help you get further into your decisions and further into trusting your decisions, the why and how. But yeah, so again, we're not done. So the next thing we want to incorporate or understand perspective-wise is how at any given moment, price is only going to do one of three things, okay? It's going to attack some form of a higher low. Let me actually pull up let me pull this up, okay? So price is going to do one of three things. It can only do one of three things, okay? It can attack some form of a high or a low. It can consolidate, right? Or it can reach into some form of a PD array, a fair value gap, order block, whatever the case may be, right? You can make the argument that, highs and lows are PD arrays, okay? But essentially, I'm just separating the modes of delivery, right? Like it can trend towards a low or a high. It can be stuck in a range and consolidate, or it can reach up and retrace into some form of a PD array, or it can reach for a PD array of some kind. All right. So when you get on the chart, right, you want to take those three elements and assume, what is price doing here? Well, price reached up for a PD array, which we were ahead of, by the way, a week ahead in advance. Then once price got there, right, that fulfilled one of those three things, right? It was reaching for a PD array. Okay, what PD array was that? It was a volume imbalance and a fair value gap in a downtrend, clear break in market structure, and no reason for it to go higher right at that moment. Okay, once it hit that, now what is the mode of delivery potentially going to be? Well, when you classify this liquidity in here, what is that? That's an internal range liquidity pool. The lows in a downtrend are classified as external range liquidity. Okay, so price goes from internal range to external range, then back to internal range, back to external range. And within that, obviously, it can consolidate. So again, like I said, there's only one of three things it can do, right? It can attack some form of a high or a low. It can consolidate, or it's going to pull into some form of a PD array. So again, when you get on the chart, ask yourself, what is price doing? Well, we've came from this fair value gap, so it was attacking some form of PD array. Once it hit that PD array, what happened? It started to deliver. Where's it delivering to? It's attacking this swing low, right? So what is going to be the potential continued mode of delivery going into the new week? Most likely, it's going to try to continue to attack to attack the swing low there. I mean, it's very simple, right? It already fulfilled internal. Now we're seeking external. It already hit a PD array in a downtrend that's now providing evidence it's going to continue potentially. And we have a very clear, easy target to identify on this weekly chart. So what do you think the idea is going to be when we go into this next week? It's going to be continuing to identify this low as our very next target. Very simply, right? And again, this logic hopefully is sounding simple because, again, this doesn't have to be super complex. And maybe it feels a little bit disjointed right now, but it's just going to take a little bit of time. And that's why getting on these calls and watching me apply this on a regular basis, that's why it's going to be very eventful for those of you that do find value or see that there is something here that's making sense, but maybe you're just not there yet, But again, just another reminder, definitely like the video, share with your friends. It's much appreciated. It lets people know that, it's worth coming and checking us out, So yeah, I appreciate you guys that go ahead and go do that. But yeah, again, this stuff doesn't need to be complicated. I hope that, the last, 7, 8 things we've talked about so far have made sense, right? From classifying things in terms of the 3 pillars. It's going to attack some form of higher lows. It's going to consolidate, or it's going to reach for some form of a PD array. When you get on the chart, you want to ask yourself those 3 questions, right? And if you can decide which one of those 3 things is taking place or could take place, especially if you do it on the higher time frames, you already have a strong baseline as far as where price should want to draw to. Because higher time frame is the actual narrative and storyline. And if you can get this right on these higher time frames, the lower time frame identification for specific directional moves makes a whole lot more sense. And there's less chances for you to be flip-floppy, and you'll be able to stick to a narrative, right? Because those of you that have been here for a while with me as well, when it comes to bias and narrative, they're 2 different things. Okay, narrative is what we're doing here. We're identifying higher time frame characteristics and what price is going to do on this higher time frame. And then when we drop down to like the daily or the other lower time frames, anything that goes against what it is we're deciding on this weekly chart, anything that goes against that, the bias you can see is changing, right? Bias can be bullish in a downtrend, in a downside narrative, and vice versa, right? There could be a down movement, retracement, inside of a buy-side narrative on the higher time frame. Okay? So yeah, I hope this stuff makes sense. All the stuff we've been through so far is extremely useful, right? Like this is like down and dirty and elements that, people claim that they understand, but they don't. And they say that if you can't explain something to a 3-year-old, you don't truly understand what the hell you're doing. Okay? Or, younger kid, someone that doesn't know things. I think to a new trader that has a basic understanding of ICT terminology, this stuff probably makes sense. This is how I explained it to myself after years of studying ICT's concepts, because I'm not a rocket scientist. Some things seemed extremely complex, and they can be, but there's also very simple ways that you can break things down. And ICT's mentioned this year in a space that he mentioned it a couple years ago too, but he purposely makes things complicated. Okay? The ones that spend time digging into stuff can figure out the simplicity to it. But most people don't stick around because, he teaches in a way that weeds out the lazy. And I don't blame him for doing that, because this stuff takes time and you have to be very passionate. And if you're dedicated and passionate and people want to waste your time or rip you off, I can imagine why he would do things the way he does and where the frustration would come from. But I'm giving you guys a silver platter breakdown of how simple this stuff can be in terms of one of the hardest things, it is one of the hardest pieces to the puzzle, which is daily bias, narrative, and higher time frame, weekly, monthly, so on and so forth, and fundamentals that, You know, if you don't notice it yet, you watch it over a couple times, you're gonna see how uh, just how dynamic this stuff is. And most of you guys have already seen how dynamic it is because you see the performance weekly, especially in my private community, right? But yeah, so I hope those three modes of delivery make sense. That's a way to identify the mode of delivery and what it's doing at a basic, bare bones level, right? It can only do one of three things. It can't do anything other than that. If you think it can do something other than those three things I mentioned, definitely let me know in the comments. But there's pretty much nothing else it can do. Classifying from the PD arrays, consolidation, and attacking some form of a higher low, right? So at a basic level, it's all price is doing over and over. And if you can decide which one of those three things is in play, and then couple all the other things we've mentioned, you can get to an assumption for daily and weekly and monthly bias fairly easily. And of course, to trust it and trust all these different elements, each element is going to take time for you to trust. Me just saying this is giving you a roadmap on what to look for, what's important, why things are important, and how you can go and apply them. But it's going to be up to you to apply the stuff and build the trust. Each element we've talked about so far, think about it as a relationship. You have to build trust with each component, each tool. Part of that can come from you hopping on my lives and seeing me real time apply them, and seeing them play out like Sufi and my private community and free community saw the last couple weeks. Private community's seen it for years, but yeah, just accept that, admit that to yourself, and just enjoy the process and the aha moments that arise from the studies you take part in. And hopefully so far this stuff has made sense, like I mentioned. So another layer to this tool, or this suite of analysis tools, is obviously my favorite component to my trading in general, is market maker buy and sell models. Okay. Let's take this past week, for example. Let me fix my template. I don't know why this changes it all the time. It's so annoying. Yeah, so let's take this past week, for example. Okay. We identified that weekly fair value gap. All right. I guess it. Oh no, I didn't put it there. So yeah, let's take this week that just passed, right? I called for this weekly fair value gap to be attacked when we were down here. I said there's potentially a likelihood, if we can break through this wick here, for it to come up there. And because 3 PD arrays weren't violated to the upside, if it hits this and declines, we'll probably end up setting up a market maker sell model, right? But we have all this other back end stuff that we talked about that led us to believe that price was still going to go lower. But once price got up into this level up here, right, as it was trading up there, I mentioned the fact that we're potentially going to see this consolidation, these equal lows, and this rally up turn into a market maker sell model if we can get a breakdown from this weekly fair value gap, and of course layering a lot of the other elements we've talked about today, not just the market maker model itself, but multiple layering effects. But once we looked at this going higher and I saw this start to decline from here, I anticipated these equal lows being violated because we were in a downtrend. Another thing I'm not going to get into today, but I get into for the most part on the majority of my live calls, is the validation invalidation principles. And the validation invalidation principles from the weekly chart, in a nutshell, the 3 PD arrays weren't violated in this case. So that didn't turn off the downside delivery, and everything's screaming sell side from the world events to the components that we've talked about today, aside from COT. Okay. Right. So the 3 PD arrays in this case would have been the middle portion. I mentioned this on Sunday, last Sunday, as price delivered into, or was down here and started the delivery. The three PD arrays were this middle portion of the wick, the volume imbalance, and this fair value gap. I said if it was to violate this fair value gap, our invalidation principles would have been turned off, right? If you go back and watch the Sunday call from last week, I mentioned this, okay? And then all the other Sunday calls as well. I always give my invalidation and validation areas to justify whether we're going to continue to hold them, what would turn off my interest and make us reevaluate. That invalidation validation principle, in this case the validation principle, stayed intact, right? And then we got that beautiful delivery from there. So again, coming back to market maker buy and sell models, as price was running higher, I mentioned, if you go back in the private Discord for my private students or my free students, as well as my YouTube students, you can see that I mentioned price going higher may set up this as a market maker sell model, the weekly fair value gap being the potential smart money reversal, which you could see it was. And then if we can get that to continue to support the downside delivery, layering the market maker sell model understanding with all the other components that we've talked about, you can now start to see yet again, we're layering more confirmations from Power 3 and all the other things we talked about to now adding market maker sell model frameworks to have an even deeper solidification for the downside delivery taking place. Okay, so you could see how each component works together. Okay, and I mean, there's nothing better than what it is that we're doing here. There's nothing better than smart money concepts, specifically ICT based concepts, not, this SMT crowd that uses supply and demand. They're trying to add things and rename things and do this and do that. Some may be profitable with whatever they're using, but again, you might as well get the right stuff, and learn from people that actually apply the real concepts, like charter ICT students that prove themselves like I do and so many others. Not any of these fake people that rent Lambos and try to sell you a lifestyle, because it works. It just works. And it makes sense as far as why something should take place, how it should take place, how can I trust it, and when is it time for me to reassess and make adjustments. You know what I mean? Yeah, buying and selling pressure is not... Price is offering the market at specific price levels. Okay, it doesn't matter how many people were buying in here, price would have still went down because they're repricing based on the economic situations that are taking place. They're offering price at different levels, in this case to the downside, basically trying to justify what's taking place in the freaking economy in the U.S. It's going to get better. It's going to get worse before it gets better, but, that's okay. Some pain is okay. This is where millionaires are made, especially for long-term investors. Everything is at a discount, or it's reaching towards a deep discount. When you go to a store, you don't get worried because the red sale tag says, there's a discount going on. Well, when you see the market declining, unless there's something dramatic destroying someone's country and their economy, downside delivery is pulling price to a discount. That's it. So if you're a long-term investor, do what you will with that information. But, being a day trader, it doesn't matter where it goes. We just have to figure out how it's going in whatever direction, why it's going in that direction, how can I trust it, and where can I get in, right? And how do I manage risk? So those are our main priorities. But yeah, there's no buying and selling pressure. It's offering price at lower prices. It's offering price at higher prices. And then once it gets to levels like a PD array, like this here, the weekly PD array, weekly fair value gap, price responds, and there's signatures that we use to position ourselves and trust and anticipate where price is going to go. And in this case, it went lower. So all the things that we've talked about today led me to believe that shorts were going to continue. And those of you that got to watch and witness it real time, you saw us calling this step by step, a week plus in advance. Okay? Even in this consolidation in here, I was mentioning there's probably going to be some type of retracement. Where could it go? Well, I had that wick, right? I mentioned this as a balanced price range, right? Buy side and sell side was offered. It was a huge wick. for a week or for 2 weeks, it held up. Once it violated it, right, it came up and actually swept that high, but it was all in the context of a weekly fair value gap delivery to just set up continued shorts. And because the fair value gap held, which was, the middle and the upper portion of that fair value gap was our invalidation validation level, because it held up on that weekly chart, and the weekly chart is where the true story resides, we were able to continue to trust while everybody was trying to buy, thinking this was, the low. We were able to get in line with the shorts because we understand the things that we're talking about here. And for those of you that don't fully understand each component just yet, you're seeing the fruits of what it is that I'm telling you guys about. What can be the result if you apply things properly. All right, and then, that's pretty much all I had to, or all I wanted to really discuss. Okay, so we talked about 10 things today in this video. Okay, we talked about risk on, risk off, the importance of that. We talked about seasonality. Okay, here, let me actually pull this up real quick. So this came directly from a PDF I'm bringing to my private community students. Okay, because I have a system that all my private community students, obviously you guys see my system, right? Like I'm here showcasing the results and what I can do. But being part of my private community, you get access to tons of different resources. Part of the resources that are coming are breakdowns of each component, deep dives plus videos, breaking down each component in great detail. Obviously, I'm giving out a lot of stuff that's still helpful regardless, whether you're just a YouTube subscriber or a free Discord subscriber. You're not being left behind. It's just, there's people that want to be freaks of nature and people that just want, to be consistent. And either direction, you choose, there's a resource for both. And both can lead to success. There's more of a customized, personalized approach with mentorship when it comes to my private community. But then, of course, there's a generalized, non-negotiable, very repeatable, effective framework for the free communities as well. So it just depends on what you're looking for and, whether you want to, like, where you want to take your trading. Both directions are obviously profitable in terms of your learning. That's proven and shows evidence by the testimonials, the nonstop testimonials I get from the amazing students that are gracious enough to give me their time. And I appreciate seeing all the progress and keeping me updated and stuff. Sufi does that, Nutty Fafa does that. And you guys are specifically testaments yourself to the effectiveness of the things that we're talking about. And that's part of why, I'm mentioning this here, because the biggest question I get is daily bias and narrative. How do I determine that? Well, you just got a big, huge breakdown masterclass as far as, the elements I use personally to be able to be as consistent as I am with where price is going to go. Of course, bias is not the only thing. You can understand bias, but overtrade and over leverage and blow your account out and then try to blame your ability to call bias and narrative based on something that doesn't even relate to bias and narrative, that being discipline, a lack of discipline, and risk management issues, maybe psychological issues. Maybe you're going through stuff and you're having a hard time in your life. The stress is killing you, so you're maybe coming into the market trying to demand things, and the market slaps you in the face, blows your account, and tells you to try again. So there's other factors, which, these are some things that I help my students through on a more intimate level in my private community. It's more like it's the private community versus the free community is just like having someone that you constantly have access to. There's a limited amount of access on YouTube, but obviously if someone's going to invest in me as their mentor, they are owed my attention. They're owed my time, So, and it weeds out those that just come and casually watch versus those that truly want to make this a career and, won't waste my time. because my time's very valuable when it comes to investing in someone. It's the same way I would see how a student should see a mentor. If you're investing your time like you guys graciously are, it's only right that the mentor provides you that grace as well. That's why I do what I do on YouTube and don't leave the students in my free communities behind. I have free students that are crushing it too. Nutty Fafa is one, Sufi is going to be one, and there's a couple more in the free communities that are just absolutely amazing. So yeah, just wanted to lay that out. But yeah, these are the things that we talked about today. This is my process. These are things I'm observing. Okay, and each of these things take time to master, and everything that we talked about today allows you to go in and apply things right away. Okay, now the trust factor comes later on. Okay, I could just say something and it all may sound like it makes sense, but the trust factor is something that is vitally important to put a lot of attention on, and that trust factor is going to come from you applying this process from A to Z, okay, from 1 to 10, and going in and seeing how things play out from week to week, day to day, month to month, and year to year. Okay, it takes time. So hopefully this stuff makes sense. I hope you guys were able to, maybe solidify some things that I've already spoken about. Most of the stuff I've continuously showed. Some stuff like fractals and stuff like that I didn't really talk about much on my YouTube channel. But this here, I feel I'm satisfied with this video. I made a couple other videos specifically directed at bias, but it wasn't as focused as I wanted it to be because I mixed in a bunch of other things as well. But this here was a master class for you guys in terms of my process. Those of you that are maybe new, join the free Discord, see what students are saying. Those that have been here with me, I know this industry itself is the hardest industry to build trust in, and that's why I do what I do. I'm not here to sell you a dream. I'm not here to show off my Lambo or this and that and all this other nonsense that's totally irrelevant. I'm here to get you guys to understand the how, the why, and how you can trust things. Why price does what it does. How can you build trust behind your own abilities? And again, if there's extra help that you need, if you want more intimate, relationship, if you want more of a personalized approach, then you can consider checking out what my paid community offers and what we do there. But again, the things that are on my YouTube channel are catered to a lot of your guys' struggles as well. But it's catered to what I believe is super important and most easily applicable. And thankfully, I've been able to get a lot of good reviews for the things that we talk about here on YouTube and the things that we do live on a weekly basis here on YouTube as well. But yeah, if you guys aren't part of my free community, definitely join that. But again, I hope that all this stuff made sense today. And yeah, that completes and concludes our Keys to Daily Bias Masterclass. And as always, if you guys have any questions, any concerns, maybe some didn't make sense, join my free Discord, maybe leave some comments with your questions and concerns, and I will definitely do my best to cater to whatever it is you're having trouble with. But yeah, so with that being said, I hope you guys got value. Thank you for your guys' time, and for those of you that are going to hop on with me tomorrow and Tuesday, I will catch y'all on the next one. God bless, and have a good rest of your weekend, you guys.